Welcome to Digital Currents, brought to you by Morgan Creek Digital. I'm Xavier Segura. Each episode, we spotlight the topics and people changing the tech industry with a focus on AI, blockchain, chips, and big data. Thanks for listening, and please make sure to subscribe if you like what you hear. And remember, stay current.
Hey, Mark, happy Friday. Welcome back, listeners, to another episode of Digital Currents. Mark, we are back on schedule.
Back on schedule. We got the dark blue going. You know, I love the cowl neck. I got the hoodie. Again, it's cold down here in North Carolina. I'll do a quick reveal and then we'll dive in. But you know, it's back to Bitcoin Orange. So I got the Bitcoin Orange going on. But I went way in the Wayback Machine with the Magic Internet Money Wizard sock game, and one of my faves. I just love that Reddit wizard. But you know, we've come a long way since the days of Magic Internet Money.
Indeed, Mark. On that point, you know, we had an episode last week on kind of talking about, you know, post-winter. What does that look like? You know, we're kind of in the throes of wiping out some of the leverage. And man, it was funny on our IC this week. We were talking a little bit about our strategy on Bitcoin and other crypto. Yeah. And I was quoting a price, and then everybody was like, no. Actually, we're way lower than that. I was like, hold on, let me refresh. And I feel like we have to refresh again, Mark, because now we're up. So, you know, we're in this magical phase. What has happened?
Well, look, it is to your point. It is pretty amazing how much volatility. So, you know, in the course of the last week, right, we're dead flat. Like, exactly. Same price that we were a week ago. But intra, right, we went from 90,500 down to 84,500. We're there for about a nanosecond, and then right back all the way up to 93, and then settling back down here at 90,400. So it's interesting. You look at the month, okay, we're down 10% over the month. Okay, you know, not a disaster. But there's been some volatility. We've gone down significantly more than that since. The one that's, I don't know what you'd call it. A lot of people are clinging to this. They're saying, well, we're down for the past year, which is true, right? I mean, we're down about 5% over the last year. Mm-hmm. But what's missing, and what they're saying is that we've been in a bear market for a year. I'm like, well, it's hard for me to call going from 90 a year ago to 126 on October 6th a bear market, right? I mean, that's a pretty good move. And then we've had this rapid correction, and we can talk about lots of different reasons for that. But I just think it's interesting. I think the mental gymnastics that people are doing to try to prove that the 4-year cycle, or the 3-year 11-month cycle, as I talk about it, is over, is really interesting. You know, we peaked exactly like to the day, 3 years and 11 months, which I don't know, that's just a little weird. You know, someone said it's like we live in a simulation. Maybe that's it. But what's more interesting to me is we flushed out the super levered, which we've been talking about. And that is what happens. That's what causes the top, right? And so that's the same. And yet we have people saying, oh no, that was just a slight correction and now it's up only. I'm like, well, okay. I mean, that's certainly possible if all the leverage is cleared out, if the coordinated attack, right? It's been now labeled choke point 3.0. If that's not real, right? If this thing about MicroStrategy and getting de-indexed isn't real, right? If that's not real, then okay, I can see that that'll change things. But if that's real And if there's some language in the Genius Act that really kind of favors stable coins and CBDCs over other technologies, okay. But I don't know. The deeper I peel back the layers, it kind of looks the same, minus one piece, which is, and you and I have talked about this before. It's one of the oldest tricks on Wall Street. When you want to buy something, you don't run out and tell everybody how much you love it, right? You don't publish articles how great the asset is. You don't tell all your friends to buy it. You actually go short said asset. You tell everyone you know how much you hate it, and you hope that the price goes down in the short run so you can accumulate a bigger stake. And again, you know, I might be prone to alternative views. I don't like to call them conspiracy theories because it's only conspiracy if it isn't true. Alternative views. It might be an interesting coincidence. Vanguard, right? The vaunted Vanguard 2 years ago. Basically, the CEO is like, over my dead body. He didn't say over my dead body, but he said, as long as I'm CEO, we will never allow Bitcoin ETFs. He's no longer CEO. So new CEO said, yep, we're going to have Bitcoin ETFs. Now, a disaster for them would have been to, at 50,000, say nope. At 90,000, say nope. At 126,000, yep, let's do it. I don't know. That just seems curiously coincidental to me.
Yeah, well said, Mark. And I guess maybe, you know, jumping into the numbers a little bit, you know, just 2 months ago, we were celebrating that new fresh all-time high of 126,000. And then that market cap was 4.4 trillion. And in just a couple of short weeks, we have seen, you know, the market shed more than $1 trillion in value. And, you know, we are now kind of in this mood where, you know, I think there was a point in the summer, Ethereum was the risk on, risk off asset. I dare say that crown has rebounded itself to Bitcoin. And now, you know, we're seeing this rise in positive sentiment. And I saw an interesting report, Mark, and this was from Inside the Fort. Okay. So this came from Christian Castro, who was the director of business development at BlackRock Brazil. And when he spoke about, you know, what was the most profitable product at BlackRock, he mentioned it was the Bitcoin ETF, which, as you know, has been unloading more and more inflow into just by, you know, now 3% of total supply.
Yep.
I find that, you know, with the literally, you know, thousands of products that BlackRock has, that little old Bitcoin ETF that was once maligned, never would work, didn't want to do it.
Yeah.
I mean, the top generator, they've generated hundreds of millions in fees and have reached, you know, 70 billion in assets. This becomes, as you mentioned, Mark, a self-fulfilling prophecy where, you know, at first, you know, there's a bit of pageantry here where it reminds me we're thoroughly in the throes of college football season, right? Where this is nothing more than a beauty pageant. If you schedule a really tough out of conference game in the beginning of the year and you lose, right now we live in a world where there are no real consequences, right? Because you could say, oh, the team was new, or, you know, that team actually ended up being really good and we ended up improving as well. And by the time you get to the end of the season, now you're really kind of boosting up the resume. So you can have the same event viewed in two different ways, which is exactly what's been happening with some of these prices. Now the sentiments have kind of shifted towards positive.
Yeah.
And we're seeing this, exactly as you mentioned, that while there have been, you know, rapid fluctuations, you know, 7% just on Tuesday up, being down quite a ways.
Yep.
We're back to where we started. And I think maybe that's where we'll close the year.
No, I totally agree. I have a different take on the college football thing.
Yes.
I mean, there's definitely a beauty pageant, you know, because people talk about the eye test and, you know, beauty's in the eye of the beholder. But I think it's actually an F1 race, right? And what do I mean by that? I mean, okay, let's think about it. F1, there's a starting position, right? And How do you get that starting position? Well, there's pre-qualifying. So you try out, and whoever runs the fastest lap, single lap, right, gets the pole position. And then second, third, fourth, fifth, kind of like preseason. Now, it's not exactly running a lap, but it's, hey, how'd you do last year? What do your players look like? What's your equipment? What's the car look like? And so it's a little bit more subjective than F1 maybe, but it's pretty good, right? And so then you start the race. And the first lap, first week, things happen, right? Let's take Texas versus Ohio State. Texas saying, well, we shouldn't schedule that because we lost and it hurt us. No, it didn't. You had the pole position. Think about this. Texas had pole position, right? All you got to do is run a clean race. No one can pass you if you run a clean race. But Ohio State zoomed past them. They didn't fall to like number 20. They fell to like number 3 or something like that, or 4. Okay. That was lap 1. And same thing with Notre Dame, Miami. Notre Dame went down, played Miami. Notre Dame was 6. Miami was 10. Miami pulled ahead. Notre Dame fell a little bit, but they didn't fall down to 20. And so you run the laps. And the thing is, where you are, think about it, the only way you can get ahead is to pass a better driver, right? A higher seated driver. And the way you fall is you make a mistake. Or another driver that everyone thought wasn't very good zooms past you. And so, and here's my other thing. So you look at something like Miami, right? Miami, yes, they had a good first lap. Awesome. But then in the middle of the race, not only did they have a bad lap where they lost to an unranked team, then they had a really bad pit stop where they lost to a second unranked team. And think about it. If you go in the pit and your wrench gal drops her wrench and you do, 11 seconds instead of 3, you don't get to say, hey, no, I was ahead of that guy. That's not how it works. You are now behind because your pit crew made a mistake. It's just the way it happens. So the only way to get back is to pass somebody better, but they didn't play anybody better. And they didn't make the conference championship. And then BYU saying, oh, we're the best. Well, you were ranked way down here to start because people looked at your team and said, okay, talent-wise, maybe not as good as Ohio State, schedule-wise, probably not as good. Okay, so what do you got to do? You got to drive better. So you got to drive. And they did. They drove pretty well. They beat everybody they played. But then they got up towards the top, and they had to play Texas Tech. And I don't know if you watched the game.
I didn't catch it.
They hit the wall, man. They didn't belong on the same field. I mean, it was a wipeout beyond wipeouts.
Oh, wow.
Okay. I mean, it was like 28-0 for almost the whole game. It was just not. And so you don't get to move up. And in fact, you lost a couple spaces because you just looked so bad.
Right.
And now they're like, but if we pass them on the last lap, then we should go past these other guys. I'm like, well, okay, fine. If you beat them fair and square, yep, you get to move up. But if you don't, you got no claim. I mean, just no claim. And so anyway, I just think it's really interesting because how you start does matter, but you can overcome it if you're really good. And, my team, Notre Dame, we had 2 crappy laps, but then we rode a perfect race. We didn't let anybody get by us. And we're sitting in a pretty nice position and everybody's complaining. I'm like, no, we didn't stall. We didn't make a bad pit stop. We're comfortably in the top 10. I don't know. It just seems pretty simple to me that how you're driving at the end of the race is the only thing that matters.
I mean, it goes back to my old track coach. Shout out to Mr. Bill Smith, wherever he may be. It's not how you start, it's how you finish. You can't win a race in the starting line, but you sure can lose the race at the starting line. And man, did we get that one wrong, Mark. In the beginning of the year, that top 5, I'm sure you have seen the names. Texas was number 1, Penn State was number 2, and Clemson was number 4. All of those have severely dropped off.
Well, Penn State and Clemson, they hit the wall. They DNF, did not finish. Right. And that's a perfect analogy, right? I mean, if you don't finish the race, you cannot win. As your track coach said, right? I mean, you cannot win if you do not finish. And if you lose 5 games, you're just not. But you had a good starting position.
Yep. There was one story, Mark, that we had to kind of opine about, because we talk a fair amount about the intersection of media and tech. I think that's really where the big data piece comes in. So big acquisition was announced. So Netflix is reaching a deal to acquire Warner Brothers for $82.7 billion. And this is pretty interesting, Mark, because this was actually a bit of football that was being tossed up in a bidding war against Paramount. Yes, that Paramount, the one that is tied to the Ellison family, which is all about the data. I think that this is going to be a really interesting one, Mark, because they're obviously, Discovery got spun out, but that's not really the prized assets. They're trying to go for the real kind of content producers in Warner Bros, the studios, the franchises, the superhero stuff. And I think this is going to be a sign of things to come. We've spoken about how the media world will continue to consolidate, and also this, to me, Mark, signal. And let's see if you combine this logic. This signals the true start of the Web3 media takeover. Yeah. Because what happens in one end of a era is mergers. Netflix would have never bought other content producers. They made their own. They use the data from what you watch, what I watch, and they say, you know what, we're going to create this amazing show, which will be, West Wing 2.0, because you like political thrillers. You like, at that time, before he went crazy and was discovered to be a bad actor, Kevin Spacey, and you come up with an amazing show at the time, right? Now they don't do that. They said, you know what? We're going to buy this archive. We're no longer going to lease these titles, and we're going to kind of put it all under our platform. To me, that means that their time is now transitioning. I'm not saying it's going to be over. It'll take some time. It's now kind of transitioned into another life stage, just as we've seen some of the other tech giants, like a lot of articles in Google news have been pointing to them just being so far behind in the AI space that they cannot catch up. So when I read something about Netflix in the same kind of vein and pay $82 billion for Warner Bros., I think this is good news for Web3, because this is the start of a new era.
100%. No, it's great insight. And, I think what people are starting to figure out, and it's hard, as the fear mongering about AI has been epic, right? Even though AI has been around for 70 years, all of a sudden, it's going to destroy all the jobs this year, and we're going to have, Terminator next year. And probably neither one of those things are going to happen. AI is a tool. Data are the natural resources. And to your point, and we talked a little bit about this, I talked about the Eminem song that AI redid as a soul kind of, and it kicks, man. It is so good. And it's good because the beat and the melody and the guy's voice, but it's the lyrics, and the lyrics are the data, right? Mm-hmm. Marshall Mathers created that, or maybe, I don't know if he wrote it or someone else wrote it. I actually don't know that, but somebody wrote it, and that data is really, really good. And so if you can now use AI tools to massage the data, like say Warner Brothers has this just huge locker, huge war chest of things, right? Good content, good movies, good characters, good images. And now you're going to use these tools that Netflix has, Netflix, Amazon, Pandora, few others, Spotify, have perfected, I think, maybe perfected is too strong, but nearly perfected this art of sifting through the data and understanding preferences and likes and wants and desires. And to your point, describing how genius is it to say, okay, people like this, and this. So let's create something like K-pop Demon Hunters. Like K-pop Demon Hunters on the surface is just another animated movie. There are thousands of animated movies for kids, but that one went completely viral all around the world. Like my wife just got her top, the Spotify, I don't know what it's called, Spotify Spotlight.
The wrap up.
The wrap up. Because I don't Spotify, I Pandora, but you get the wrap up, right? Yeah, 2 of her 5 songs, so 40% are K-pop Demon Hunter songs. Now that's probably because of our grandkids, but it was.
I'm right there with her, Mark, and I think as we kind of look at how that data can be influenced, for right or for wrong. I mean, I think when we kind of think about, is this going to go through, right? Because that is the not so certain thing. Because if they don't, there's a $5 billion breakup fee that will be assessed, which is not trivial. But this is something, Mark, that we'll have to at least keep an eye on, because I think it'll affect all of our worlds. Because I remember there was a time when YouTube was the disruptor of cable.
Absolutely. Look, and Uncle Larry, and what we don't want as society, just me personally, we don't want everything controlled by one group. That diversification is way better. And we had a little conversation about this the other day at IC, that I am struggling with this a lot right now, which is, the internet in its original form was open, right? It was free. It was available. It was comprehensive. Meaning, we started with encyclopediabritannica.com. You always mentioned that was the most valuable asset in Web 1 at the beginning. And then other people started building websites, and then everybody built websites. And the genius of the internet was all of human history's information that we have translated and is available was at your fingertips. And so you want to learn about something, you can go. You want to know something, you can get. But then we had these search and search, right? In the original, you search through the internet to get what you want. Well, then Google came up with this better way is, I'll index everything and I'll put the answers in a place. And when you ask a question, I'll send you. Well, yeah, but there's the element of, could there be bias in where you're sending me? Could there be a pay to play? So that is a little less good. But then OpenAI comes in, so, we have this better system. Well, we'll use AI to interpret what it is you want, and then we'll give it to you. No. I don't want an interpretation. I don't want a prescribed answer. I want the data. And then you get into the really dystopian world, which is when the OpenAI browser came out and someone said, show me pictures of Hitler. And it said, no, I can't do that. Like, what do you mean you can't do that? That Hitler's not illegal. I mean, you don't have to like it, and you aren't supposed to have an opinion. You're supposed to be a tool. So, and then it goes even further. It's like, and because you asked that question, I'm reporting you to the proper authorities. Whoa. And then worse, and I'm sorry, I had to charge your bank account because that's a violation of rule such as, that's a world I don't want. And I don't want this managed internet, this managed AI created world. If I ask Netflix to show me something I might like, I don't want them just to show me K-pop Demon Hunters because that's their top selling show. I would actually like them to look at my data and my preferences and my history. So I don't know. There are lots of good things, but if everything's controlled by one group, we're not going to get what we want or deserve. We're going to get what they want us to have. That's a bad world.
Mm-hmm. Yep, I agree, Mark. And probably the last thing I'll mention before we shift gears out of blockchain is on Fusaka, which is the second largest major upgrade in Ethereum land and the 17th major upgrade of the protocol over the decade of its existence. The ETH heads would say, Mark, that is a feature, not a bug, as far as the upgradability of the product and the blockchain. The kind of analysts are kind of looking at this as a potential price catalyst to see if things can recover and rebound. So we shall see. They have obviously lost a lot of ground from their previous highs this year, and they're kind of trending on that.
Look, it's ETH has a challenge, right? It was first in terms of the EVMs, and smart contracts will play a role in the future for sure. Now, what role and how big and how pervasive, that's yet to be determined. But, look, ETH is down 17% this year, is down 40% from its peak in August. So that's less good. You look at its primary competitor, okay, Solana. Okay, now if Ethereum's down 17%, Solana should be cheering. Well, but they're down 37%, and they're off almost 50, actually a little more than 50% from their all-time, from their, not their all-time high, but from their previous high. So
right.
Then what are you saying? Well, then it must be XRP must be going to take over the world. Interestingly, XRP is flattish, is down, about the same as Bitcoin for the year, down a lot from its high. I mean, down more like, 45% from its high. So all worse than Bitcoin in terms of damage. And the real problem, to pick on, XRP again, and then I'll pick on Cardano like I usually do. XRP was announcing that they had this deal with one of the big banks, and then the big bank actually came out and announced that they're going with Chainlink. And again, you can't announce things that aren't true just to announce them. But I will say the one thing that the Ripple Foundation guys continue to do, they keep acquiring real businesses. Like they keep acquiring real cash flowing businesses or acquiring a lender. They just, first they acquired a prime broker. Now they're acquiring a lender. So they actually might end up building, so they might end up building a real company on the back of donations from the XRP army. So, good for them. And then, Cardano continues to have zero projects that do anything, and that Charles Hoskinson continues to make waves in DC, but your protocol really isn't being utilized for anything. So I don't know. It's all very. I would have thought it would be more settled by now, but we're still early.
I think probably the interesting topic for us to talk about, Mark, we're always kind of examining valuations. And I think when we talk about the tech side of things, it's really kind of within that guise to figure out, how things are priced. Are they overvalued relative to the sum of their assets? Or is there some, multiple here? And what is that comprised of? So one thing that I think has been a really different trend has been this idea of a king-making strategy to anoint early winners in AI. So maybe spending a cycle as we kind of talk about a new shift that some of the bigger firms have been doing. So, and moves led by the guys like Lightspeed and Cold Slice, 16Z, Sequoia, all those Sand Hill Road guys They're basically now, as we've been reporting for really years at this point, Mark, deploying oversight checks to help their chosen companies overwhelm their competitors.
Yep.
And so, when you look at how this was a strategy that used to happen at the end, Mark. So when Morgan Creek, when we invested in the Lyfts and the Ubers of the world, that was already when the horse, in some ways, left the station in their race.
Yep.
But they were taking on a broader set of competitors like the taxi cab industry. So there was still growth to be had. But they were already established as the winners of their category.
Yep.
That's not what's happening right now in the AI world on the VC side. So, when you look at some of the past failures, things like Convoy and Verge, early kingmaking does not guarantee victory. So your thoughts on this strategy?
And that's such an important insight. And I think people really need to think about that in the sense of declaration of being a king, right, is not how it works, right? You become the king by providing a good or service that people want. I mean, Netflix is a great example. They didn't come out and say, we're the best. They actually came out and almost went bankrupt twice because they tried something and it didn't work. And speaking of trying and not working, I don't know if you've seen the video of Giannis. It's from a year ago, but people are resending it out. Everyone needs to watch it every year. I mean, it's just 2 minutes of just brilliance where a reporter asks him, isn't this year a failure because you guys didn't win the championship? He's like, are you joking? Right? I mean, I learned, we learned from this and we'll try to get better next year and try to win another championship. So he's like, so from 1971 to 2021, when Milwaukee didn't win a championship, those were all failures.
Right.
Michael Jordan played 15 years. He won 6 rings. So those 9 years were failures. And the reporter, well, no. Of course, exactly. So failing is good, right? You want to fail. It means you're trying. And, the teams that lost 2 or 3 games this year that don't make the playoffs, they'll get better and try again next year. I mean, that's the way it works. And
that's why we play the game, Mark.
It's why we play the game. And then so that was it's just mandatory listening. And then there was another one, Kobe, talking about the woman interviewer said something like, I got to get it right. What's it like to, shoot. And it was the same idea that Kobe was basically saying, no, you keep playing and you keep learning and you keep overcoming and there'll be setbacks along the way, but it's not it. Oh no, she said do you hate to lose or love to win? Neither. She says it's a dumb question. I mean, he didn't say it's a dumb question. He said, no, it's the wrong question. He says, if I hate to lose, then I'm stuck in the past. If I only want to win, then I'm stuck in the future and I'm ignoring the present. I'm like, oh man, that's mad genius. And I think the same thing's true here is at the end of the day, you just got to keep building and you got to keep iterating and you got to keep going. So to just say you're the king and the VCs do this all the time, right? They say, oh, we're going to, the 3 guys that spun out of OpenAI or the woman and 2 guys. And they wrote him a big check, like $1 billion check on a $6 billion valuation with 3 guys in a PowerPoint. Oh, they're going to be the best. I'm like, really? I mean, no. I mean, just because you're saying they're going to be the best doesn't mean they're the best. And OpenAI versus Anthropic is a good example of this. OpenAI, they were first. And they had 80-something% market share. And now their market share is going like this. And Anthropic came in and their market share is going like this, particularly at the enterprise level. And I'm not saying necessarily that Anthropic is so much better than ChatGPT, but it's got some elements that people are buying into. But the one that has them both running for cover is a late arriver, Gemini, out of Google, that's saying, hey, we trained our model on TPUs instead of GPUs, so it was way cheaper. And everyone I know who's tried it said, oh my God, this is way, way better. So, and I'm a DeepSeek guy, and so I use DeepSeek most of the time, and even though I'm not supposed to because it's Chinese, but it's just better. And their model is even better because, and I'm not a techie, but it's an open model as opposed to a closed model. And in AI, this is a big deal. Well, there's a new company that I hope we're going to get a chance to invest in, but they did this new round that was like snapped up immediately. But it's the American version of an open model, and that's probably, again, not guaranteed, but that's probably gonna topple all those self-proclaimed kings, because what DeepSeek showed is that's just a better way. It's more energy efficient, it's cheaper, it scales better, it actually produces better results. I said I do this, every day. I compare what I get out of ChatGPT with what I get out of DeepSeek, and I've been trying other things like Kimi and Qwen and things. And it's not that ChatGPT is bad. It's just it's not as good, and it's definitely not as consistent as what I get out of DeepSeek. So it's just interesting.
Love it. Well, we've kind of gotten to that point, Mark, of the part where a picture can only say 1,000 words. So when more is needed, we turn to the charts. And we remind listeners always, check us out. In addition to the podcast on the audio, on the visual, Mark, as per usual, I will project and you will comment. Had an interesting couple of charts here because last week we weren't able to do the visuals. Sorry, guys, we weren't able to get the charts, but we are covering this a whole slew of awesome charts of the week, and we will jump on in. First one, Mark, I know is going to be one that's going to be right up your alley, which is the bifurcation of asset ownership in a K-shaped economy. Yeah. Whoa, that is a mouthful. What is this all saying? Let me kind of bring this up for you. And I think what this shows, first, we're going to talk a little bit about TradFi, Mark, and then we're going to shift over to DeFi and see if we can learn anything that's being shifted. So for those that are on audio only, showing the chart where it's got two main axes, one showing kind of the equity ownership of the top 10%. That's the darker line. And then kind of the ownership percentage of the middle class, that's in more gray or darker color, is the bottom 50% ownership in equities. And Mark, this is a bit of a chart crime with the colors of these lines, which I apologize. But what this punchline is really revealing is just the higher concentration of a smaller group of people in very, very high valued assets. But I love the shape of this, because if folks were wondering why it's called the K, I mean, it's right here in the data and how this is shaped.
Yeah, it is perfect. So what the blue line showing is the equity ownership of the top 10%, and these charts are always hard because on the left axis you're going from 78% to 88%. I mean, that is a monstrous concentration of equity ownership, right? And then on the other side, you got the bottom 50%. So again, top 10% versus bottom 50%. And the bottom 50% goes from 0 to 25%. And so they're down at like 12%, and the top 10% are at 80 something percent. And yeah, that is an extreme K, right? And you can see this in everything from income to wealth to equity ownership to actually I saw one this morning that was SAT scores. I mean, it was frightening, the perfect correlation between family income and SAT scores. Now, there were occasionally an outlier, about 2% of the high scores were from lower incomes, which is a frighteningly low number. But And a lot of that is right. It's test preparation and the ability to, go to private school or whatever it is. But the K-shaped economy is so real. And the problem is it's engineered this way. I mean, this is the sinister. So we always have to go to Sinister Saturday. It's the sinister part, right? It's why the Fed was created. The goal of the system is to channel money from the masses to the rich. And the way you do that is one, you tax people. And well, why does that transfer money to the rich? Well, think about it. Who can afford to pay to avoid taxes, right? Not evade taxes, but avoid taxes, right? Tax avoidance is good. Tax evasion is bad. And two, the taxes basically represent a channeling of capital from, again, the productive part of society to the less productive part, the government part, who then makes legislation that favors asset ownership. So, whether it's accelerated depreciation, whether it's mortgage interest, the higher your mortgage interest, the more tax benefits you get, or just charitable contributions. And all these things, they're not in and of themselves inherently evil, but what they end up doing is channeling productive assets into the hands of the wealthy and channeling a burden, right? Which is, the lower half don't own assets, they rent assets, and they rent assets at very egregious interest rates, usurious interest rates. Like anyone who's ever rented furniture, like from an Aaron Rents or something, the effective interest rates are 20, 30, 40, 50%. Subprime auto loans, right? That on TV, it's all, 0% interest for 60 months. That's like for the top 10%. That's not for the bottom 90%. The bottom 90% are paying 20, 25, 28. I mean, there's some crazy numbers. Wow. And mortgages versus rent. And so all of this is, and look, it's bad and it needs to be addressed. And I would say it's the worst system that exists except for all the others. So all the others, the people are clamoring for, like socialism or communism. Like there was one the other day, someone said they should confiscate Elon's wealth and give everybody healthcare. And I'm like, okay. And I was glad that somebody actually did this. They said, okay, let's take Elon's wealth, which is criminal, right? You don't steal from people, but okay, let's do that. That would pay for 3 months of healthcare for the United States. So it doesn't work. And oh, by the way, that would destroy 200,000 jobs because the companies he worked for would go to zero because you'd sell all his stock into the market and the price would go down and then you have to shut down the companies. And then, so it was just, you got people, Bernie Sanders still out there talking about, we need to tax the billionaires and distribute their wealth. I think, no, we don't. And, they say socialism, communism stop working when you run out of other people's money. What we need, and I talked about this the other day, so why would any government want to discourage income creation and wealth generation? Just generally speaking, why would you want to do that? Well, you wouldn't. Okay, well then why would you tax it? I mean, there was no income tax for most of the history of the US. For 60% of the history of the US, there was no income tax. And there weren't property taxes. And there weren't all these transfer mechanisms. It's only in the last 100 years that we've had that. And yeah, there's some, you could say there's some benefits to it. We have good roads and we have good military and we have, yeah, fine. It's all good. You can privatize most of that. But at the end of the day, what you should do is you should incentivize wealth creation, right? Innovation. And Even Elon got on the wrong side of this the other day. He's like, we could solve poverty by just giving everybody a bunch of money. No, you can't. If creating wealth was as simple as printing money and giving it away, Zimbabwe would be the richest country in the world. They gave everybody hundreds of trillions of Zimbabwe dollars, and they're still poor. So what works is educating the masses, providing job opportunities and job training, and encouraging entrepreneurship. And in my last little rant on this is what government would think that a pay-as-you-go system would be superior to an insurance company. Like, insurance is one of the greatest inventions in history. Every industry that's successful is because they have an underlying insurance mechanism that spreads the risk from the single company to the masses, or single person to the masses. So Social Security, it makes total sense to have a safety net for people who need it. Total sense. Take care of society, particularly your elders. But the way you should do it is like insurance. You should collect premiums, you should invest those premiums, and then pay claims to people who need them. It's like your house, right? If you pay premiums on your house and your house doesn't burn down, you don't get paid. You only get paid if your house burns down. So if you are lucky and you achieve the American dream and you make millions of dollars, you don't get Social Security, even if you paid in. That's the way it should work. But we don't run it that way. We run it as a pay-as-you-go system. And the problem with that is when it was set up, there were 17 workers for every retiree. Today, there's 3. And when I reach retirement age, there'll be 2. I always say I'm going to lose because my kids will give to my wife, not me. But anyway.
Well, I think, as you kind of examine some of this stuff, it's really interesting because I think, and we'll transition into how this kind of impacts on the crypto side. When you're dealing with, 10% of American households holding close to 90% of all US stocks, that's also what you see on the crypto side, which is a little bit orthogonal to how the asset class was supposed to work, right? And as we kind of think about factors like wage growth and how stagnant that's been relative to other rising costs, it's really kind of created this divide, and how you have this K where the folks at the tip of the top keep acquiring more and more stuff. But what does that mean for Bitcoin? So let's look a little bit at the actual inflows and outflows at the method du jour of how folks are acquiring their Bitcoin, which has been the ETFs. This, I think, you couldn't have made a cleaner chart on this. You've got a trailing 7-day average of the net BTC spot and ETF inflows relative to BTC price for this past year. And so that's a mouthful. What that really means is, what do folks do on the ETFs when prices go up and down? And the spoiler alert, Mark, is they sell when prices are low and they buy when prices are high.
Yeah.
Which is kind of the opposite of what we were told in business school. Mark, this kind of is that herding kind of behavior that ultra concentrated pool of wealth is ultimately being succumbed to. But I think if we kind of, zoom in, as we've done on this start of the episode, into, what are the folks like BlackRock and other sovereigns that they represent preparing for price accumulation patterns now that things have kind of come down a little bit and we're seeing a little bit of the stabilization, could they buck the trend? Looking at this chart, Mark, I can't help but be a little pessimistic that they won't, at least for a little while.
No, I agree with your gut instinct there. And this is a great chart. So the blue, the Carolina blue color is the net inflows to the ETFs. The gray is the net outflows. And the good news is there's more inflows than outflows, and they tend to be bunched episodically. And then the black line is the Bitcoin price. And as X said, this really shows what I say all the time, that human beings are spectacularly good at 2 things. They buy what they wish they would have bought, and they sell what they're about to need. So the reason the average investor underperforms just buying and holding is because they constantly buy at the top and sell at the bottom, which is, I say this all the time, investing is the only thing. And since, we just had Black Friday last week, you put stuff on sale, people run into the store, they run over each other to buy their third big screen TV or their fourth gaming console. But you put an asset like Bitcoin or stocks or something on sale and people run out of the store. And the cheaper the price, the further and faster they run, or farther and faster they run. So it's just crazy. So I think a couple things on this that are important. One, is it correlative or causative? And I think if you really analyze the chart, it looks correlative. And what I mean by that is the price didn't go down because people were selling it. People sold because the price went down. And the price didn't go up because people were buying it. People bought it because the price went up. So that's the first part. The second part is there's a very subtle piece of this data that isn't here. It's embedded in here. And it'd be cool if they could, have two colors of blue and two colors of gray, but they probably won't do this because it would be damning to the people who are doing it. But there are two different types of buyers, right? There's the retail buyers, the people who are buying it because they heard it was a good way. And it's I call it the boomer wrapper, right? You don't have to worry about your keys or your seed phrase or your Coinbase account. You just buy it into your brokerage account and it's easy. And someone else deals with all the headache. That's a meaningful part, but it's not the biggest part. The biggest part are these institutions. And the reason BlackRock's IBIT is number one is they got all the institutional flow and the sovereign flow into it. The problem is a whole bunch of that flow isn't accumulating. It's simply arbitraging. It's selling the future and buying the spot. And every month you can make about, 6-7 points as that roll yield comes down, and then you reset. And that's why at the end of every month, you see this weird selling of the price. And then they start all over again at the beginning of the month. So it's not surprising that last week prices went down and this week prices came back up. So I do think it's important to know, are you in an accumulation phase or a distribution phase? And what does that mean? Well, a distribution phase is where early investors who have a profit distribute whatever that asset is. And it could be a private asset that goes public. It could be a stock that they bought a long time ago that they're selling. And distribution tends to happen from big hands to small hands, right? In the extreme, like Oklo and Rigetti, right, where it's a pump and dump, it's distributing, it's called feeding the ducks, right? You hype up your stock and then you sell, or what XRP does, you sell to the masses. That's less good. In this case, it's if the institutions are accumulating for their balance sheet, like Harvard. Harvard has been accumulating a meaningful position after missing it, right? 8 years ago when we offered it to them, we said we would give them Bitcoin, we would manage it, and we would charge them no fees until they made 3 times their money. And then we'd split 70-30 and they rejected us like everyone else. We pitched that to 100 people and no one took it at $6,000. But anyway, that's neither here nor there. But now they are accumulating. That's an accumulation. That's different than Millennium buying 2 billion of IBIT, but they're short 2 billion of the future against it because they're market neutral. That's a very different thing. Distribution is, we've seen some of the OGs that bought right at $100 and now they're selling at 100,000, and people are like, oh, they can't do that. I'm like, no. We want them to do that. If we want billions of people to participate, we didn't do a free and open drop. I mentioned that maybe that would have been a better way to do it. And people, the maxis are like, no, that's not proof of work. I'm like, okay, whoa. I'm just saying it might have been a more interesting way to get more people involved, but okay, fine. You were early, good for you. But we didn't do that. So now everybody says, well, we want everyone to use it. Well, if they don't own it and they're afraid of it and they don't understand it, how are we going to get there? Well, what we need is some of the OGs to sell a few Bitcoin, and people won't buy the full Bitcoin. They'll buy sats, and you can buy as little as 1/100 millionth of a Bitcoin. So that process needs to happen.
Great point for us to wrap up there. Mark, thanks so much for the insights, and thanks so much to the Digital Currents community for tuning in week after week. We will come back with you middle of next week with our next episode. We have a brief respite for our office holiday party, where we go back to the community and build houses for Habitat for Humanity. I want to remind our listeners, as always, to rate, review, and subscribe, and to stay current.
Thank you for joining us this week on Digital Currents. Check out our links to our website and social media in the show's description box. Please make sure to subscribe if you like what you hear. And remember, stay current.
This podcast should not be construed as investment advice nor solicitation for the sale of any security, advisory, or other service. Investment themes and ideas discussed may be owned by funds managed by the host and podcast guests. Any conflicts at the time of production have been mentioned by the host but are subject to change. Listeners should consult their personal financial advisors before making any investment decisions.